Here, so we're going to dive into how to trade uncertain markets using option strategies that sell options for income, profits, and hedging. So kind of a seven-step plan that we'll go through here today. And again, thanks for being here. I love these Saturday events. Markets are closed, so we can kind of kick back and just kind of review things, talk about these different option strategies, take questions, and kind of go from there. So again, thanks for being here. And what we're going to talk about are different option selling strategies that can really help in a lot of different ways for providing income, profits, but also great for hedging. So a little background on myself: I started trading on the trading side back in the 80s, trading on the oil side, cargoes of crude oil, and then into products, and just kind of never looked back. But started out with a company called Coastal Corporation in the 80s, and worked for them for 5 years, went out to Singapore for a couple of years with them, traded products, which was a fantastic experience. Then went to work for a company called Trans World Oil, which at the time was one of the largest oil trading companies in the world, with Fibro and Mark Rich and Trans World. So there I spent about 17 years and ran the international trading desk for 10 years out of Bermuda. So that's where I started trading options back in, I specifically remember 1987. We started trading options on crude oil, cargoes of crude. So it was a really exciting period of time. So when we first started trading options, it was from the sell side as well. So we were selling premium, taking in big boatloads of premium, I guess you could say. So we thought that was great. So we were kind of learning on the fly as we went, which started out good, but then when the trades started going against you, man, it was really cover what. And so but I've been passionate from the options from that point forward, and never looked back. So we are going to talk here more about these kind of option selling strategies and the premiums and the things that they provide and the big benefits you get from them. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So, trading is a business of probabilities, and to be successful trader or investor, controlling the risk is what's really going to win the game for you in the long run. So by knowing and better understanding how to manage and control your risk, it's really going to make a dramatic and positive difference in your trading or your investing performance. And the best way to achieve this goal is through the use of options and option spreads. So why is that? Well, when we look at options, they're unique. The unique pricing structures and the capabilities that the option spreads offer you can really help you to control the probabilities, and the probabilities that you can then kind of be more tilted in your favor. So we'll go through the probabilities of how this works. Now, when used correctly, option spreads are going to provide you defined risk trades. They're going to lower the capital that you put up for risk on any specific trade. And they're going to give you greater trading leverage, and they're unmatched for hedging advantages that you get from them. And remember, options were first created basically for hedging, so it's one of the things that we can really take advantage of, and we'll talk about that here today. Now, step one is to know how option pricing works. So you want to understand the concept and the components that go in to an option price in order for you to maximize your option profits. Now, when we're trading options, our option strategies designed for income and profits and hedging that we're going to talk about today, the most important option factor that makes these strategies work is time and volatility and the impact that they have on the price of the option. So when we look at the time component, it's basically your time value or extrinsic value of the option. So it's the premium that the rational investor or trader is going to be willing to pay over the current exercise value, which we call the intrinsic value, based on the potential to increase in value for expiring. So the change in this value of an option based on the time decay, we can measure that component using the Greek called theta. So what we use option theta for is to tell us kind of the basic characteristics in time decay. But when we look at option theta values, they're going to either have a positive value or a negative value. So if you're long a stock option, such as a call or put, that position has a negative theta value, which indicates that they're going to lose value as expiration draws near. Now, the other side of the coin is if you're short options. So if you're short a call or short a put, you're going to get a positive theta value from that. So that's going to tell you or indicate that if your position is, turning sideways, you're still gaining money or gaining value from that positive theta, from the time decay. So that's the key to, option selling strategies is controlling your theta decay. And that's what a couple of these different option strategies spreads that we're going to talk about will really provide you with this kind of positive theta kind of trade setups. Now, the next thing that component of option price is the volatility and the implied volatility. So implied volatility is basically what the marketplace expects the stock price to do in theory. So it's simply the amount a stock price fluctuates without regard to the direction. And it's a forward-looking measure that yields a theoretical value for the option based on the option pricing model. So in theory, a stock should end up within one standard deviation of its original price, statistically 68.2% of the time during its option cycle. So knowing the probability of your underlying stock finishing within a certain range at expiration is really key to determining what then options to buy or sell and which option strategy to implement. Now, when we look at the value of the option, it just also comes down to time value times the implied volatility times the intrinsic value of the option that you're trading. And once you know these variables, then you're going to be able to price that option out, know the option premium, and select the right option strategy. So if we look at this table, it kind of gives you a good flow through of how option pricing works. So I like to use weekly options, and every Thursday we have a new weekly series that comes out. So on that first day, that option series will have 100% time in it. And if you take the time value component times the implied volatility of the security times the intrinsic value, which is where it's trading at the money, and we'll keep this at a constant of 1, that's going to give you your option premium or price. So you can see the first day you've got 100% time, plugged in a number here of 300 for the implied volatility, kept this 1 at constant, and so you've got a price of $300. Now, when you come back in Monday after a holiday, you can see that your time component's been cut in half, and even if your implied volatility spikes up to 800 in this example, times the intrinsic value, keep it at 1, your value of that option would only be $400. So the real takeaway you can see here is that as we go into time, the time component keeps going lower and eventually it goes to 0 at expiration. And the same basically goes with the implied volatility. So when we're selling options, we're going to take advantage of this theta decay and the implied volatility crush that both at option expiration are going to be at a 0. Okay, so that's what we want to take advantage of, and that's why option selling strategies can really provide and help you with this. Okay, so let's see. So with the volatility, use just the option model. So normal volatility is basically the implied volatility. We'll go through, kind of the model and how it works in just a few minutes. So the next thing is step 2 is, so how can we trade time? Okay, so we can actually trade time with options. So by selling options, we're going to be able to trade that time and take advantage of option time decay and theta. So think about an option as like a coupon that you get at a store. So if you look at that coupon, it has kind of a redemption or date that it has to be used by. And that's exactly how options are. So we have all the different option series, and those will be a kind of finite series. So at the end of it, they expire. So it's just like a coupon. So they also, theta does not remain stagnant. So it's your theta values are gonna increase as expiration gets closer and closer, and decrease as your options go more in the money and out of the money. Okay, so in fact, the really effects of theta value really start kicking in the most 30 days to expiration. That's when it really soars. So that's why weeklies are so great, because we can take advantage of this really accelerated theta decay. So if you look at this, the time graph, you can see, let's say we go out and we start out with an option 120 days to 90 days out. Well, at that point, your option theta is going to be very, very small, very slight. So, but once you get to that 30 days out to your expiration, at that zero expiration day, those weeklies are what we can really play with to take advantage of this accelerated theta decay, which we know at the end of the day, at the end of the option cycle, is going to go to zero, as well as the implied volatility. So by selling options, we're selling time and we're selling volatility. And the big takeaway prize from that is that at expiration, those go to zero. Now, the third step is a big part of it as well. So that's the probabilities, right? So let's talk about trading the probabilities. So when you look at broad markets, they'll tend to, have trends where they'll go up, maybe up hard or up down hard, but then you'll see them kind of trading sideways. So a lot of times you'll have maybe 2 to 3 week cycles, and the markets will trade in the sideways channel maybe 70–80% of the time. Now, based on this sideways price movement, all the out-of-the-money option buyers are going to lose about 70% of the time, because those things will come due and they'll expire worthless. So the market makers, the professional money, they know these statistics and therefore want to tend or trade from the sell side. They want to sell that premium that they know is going to go down in value over time based on that theta decay and the implied volatility crush. So this is the professional money, and so we need to think like that, and it all comes down to the math and the math probabilities. So when we're looking at the option market makers and the mathematical market, that's what we're using to give us these probability statistics for price and movement of an option into its expiration. So by knowing the probability of your underlying security finishing within a certain range at its expiration, that is really key to determine then what options you want to buy or sell and what option strategy to use. Now, these statistics will forecast how likely it is that an option will fall within this certain range of its option series price range, up or down, by that expiration date. Now, and to forecast this is what we refer to as the implied move or the implied expected move of your stock. And theoretically, the implied move is estimated by kind of a plus or minus 1 standard deviation move over the current cycle of that security. So basically, think about 1 standard deviation as maybe a normal price movement of a stock for that option expiration series, either up or down. So when you're thinking of 1 standard deviation, that's really, basically, what it can actually do as far as range. So if you've got a 1 standard deviation up or down, that's kind of the normal potential price range for that security based on the day's expiration. So here's a really good graphic example to kind of illustrate this, hopefully more for you. So if we look at out of the money options, so if we're selling out of the money options, that's basically we're selling 1 standard deviation out of the money. So you're going to basically start out with an 84% theoretical probability of that being a winning trade. So for example, when we look at the delta of 1 is equivalent to 100 shares of your security. Now remember, each option contract is equivalent to 100 shares. So that's where the option delta kind of gets its total value. So if we have 100, which is the max value, 100 for a delta, and we were to sell the outside point, let's say right here, that has a 16 delta or 15.9 or 16 delta, that's going to give you an 84% probability of winning. So 100 minus 16 is 84. So if you were to sell this 520 call, you've got an 84% chance that price will be below 520 at its expiration, day's expiration. So this had 5, 10, or whatever, that has an 84% probability. So that's why when we're selling options, a lot of times in different strategies, they're referred to as probability trades. And the same goes with, in this example, if you were to sell this put. So if you sold that 480 put with that delta of 16, that's that outside 1 standard deviation point, that's going to start you out with the probability that price will be below 480, 84% probability of the time. And then to look at this standard deviation, it's just the range between that 480, the outside point, and the 520. So that's, what we're going to play with as far as, taking advantage of these kind of probability statistics to help us set up trades and have a better idea of the probability of those things working out. So when we look at this option delta, this option chain here is going to give you a good example of delta and probability. So if you looked here at Apple, for example, it's trading at 190, so right there. So if you look at the at-the-money strike here, 190, you'll see that it has a delta. That's what we want to look at for probability of 0.52. So for calls, it's plus. For puts, it's minus. So basically, the way to look at that is you've got a 50%, 50-50 chance that this will be either trading at 190 or below or 190 and above, so 50-50. Now, when you go further out, those probabilities get smaller and smaller. So if you were to go out to that 215 strike here, and you're looking at this series here, this 5 July, 28 days to expiration, you'll see the delta of that says 0.05. So the way to read that is one thing you can say, okay, that has only a 5% chance of price getting to 215 over the next 28 days. So it's 5%. So that's why you get out here to these way out of the money prices. You can see the options are going to be priced a lot lower because you're taking a lot of risk for buying those way out of the money strikes. Now, this is right here on your Thinkorswim platform. It says probability. This is probability out of the money. So you'll see here, this is your going into the trade. This gives you those statistics. So if you were to sell that 215 strike short here, just the call, that's got a 5 delta there. So one way to look at it is there's a 5% chance that it get to 215, or the reciprocal is 95% chance or probability that price will stay below. So these are the probability statistics. So that's what we want to look at. So we can quickly, analyze a stock, security, an option based on these option deltas to give us kind of the theoretical probability. So they're not always 100%, but that's the best place to start. And that's one thing that's great about options. Now, this probability analysis is going to really provide you a very super useful tool for determining price targets that you want to trade against. And it's a free, tool that you can use on most platforms. So it's a great kind of tool to have at your disposal. So based on the math of these probability statistics, you'll see that approximately 70% of options bought will expire worthless. So based on the probabilities alone, it's a good idea for all traders or investors to consider selling options as well as buying. And by adding option selling strategies to your trading portfolio, this is going to really help you make a bigger difference and positive difference in your trading performance over time. So, what helps win the race in the long run is, these kind of incorporating high winning probability option selling strategies that you can then, use for income profits and hedge trading management. So we're going to dive in more to it, but those are kind of the basic statistics that we want to look at. Now, step 4 is we want to understand, okay, what is the market maker secret? Now, this is what they don't want you to know. So, if you're trading options just starting out or been trading, this is kind of the standard deviation stuff that you can use to kind of get a better feel for your probability. So this is a good example that I put together, hopefully to illustrate this point. So let's say you're, imagine you're bullish on Tesla. And Tesla's trading at $207. So that's about where it's trading today. So as a beginning option trader, you might be very tempted to buy calls 20 days from expiration with a strike price of $290 at a cost of 15 cents, or that would be $15 per option contract. So why would you do that? Well, when you look at it, you can do a lot of them. So let's take a look at the math. Now, here's Tesla just to kind of illustrate where it is. So here it's trading right currently at 207.47. So that's where it went out, on Friday. And this is going to be looking at, okay, buying the 290 strike calls out of the money. Okay, so it's trading at 207. Looking at the 290 calls. Now that would be like a 39% move from 207 up to 290. So that's a little background. Now, if you were to purchase 100 shares of Tesla at $207, you're going to be putting out $20,700, right, for those 100 shares. Now, what if you took that same amount of money, the 20,700, and you bought, options at the $15 per option contract, those $15 strike, that 290? Well, you could basically buy 1,380 contracts of those 290 calls that were being priced at $15. So that would basically, control 138,000 shares. So that's huge, right? So that's the madness of options, but that's also the beauty of it too, because we get this potentially huge leverage. Now that's a scary thing to think about, but with options and with option spreads, we can control that risk specifically with the spread. So we look at the spread risk, and that's going to be the max that we're going to have. So we'll go through how this works. But the leverage is huge. Now, so if you were just doing naked options, the leverage is really big, but we're going to do spreads to control our risk. Now, going back through this example, let's say Tesla does hit 290 within the next 20 days. And those 290 calls that you paid 15 cents or $15 per option contract, they're now trading at $1.15 or $115. So you would have net, $100 per spread or per option as a profit. So if you took that $100 or, that you made $1 per spread or whatever, you'd make $138,000 in basically less than a month. So that's, really exciting when you're first starting out, or just period, that the potential is huge, and it is, as far as what you can do. Now, at first glance, this kind of leverage is really awesome. But let's don't let the glitter fool us, because not losing money is just as important as making money, and especially in this kind of market environment we're in today. Now, the one problem with short-term out-of-the-money options is that you not only have to be right about the direction the stock's going to move, but you also have to be right about the timing. And this is what really ratchets up the degree of difficulty. So to make a profit, the stock doesn't just need to go past that strike price into expiration, but it also must do it within a defined period of time, or else it's going to expire, right? That coupon's going to run out. So in the case of the 290 calls on Tesla, you're going to need the stock to reach that 290 within that 20 days period to make your profit. Now, this is a kind of a dual objective of having to be right on direction plus timing. And so this really, really lessens the probability of an option trade, and a lot of times being a winning trade when you're just buying options outright. So my trading plan formula is based on looking at really high winning probability trade setups, and then using really tight risk control management. So in the Tesla option trade example, you're wanting Tesla to move more than 30% in 20 days, right? So a lot of beginning option traders don't realize the downside risk and the probabilities are really against you a lot of times when you're doing something like this. So in this example, this would be like a 3 standard deviation move. So 1 standard deviation move is kind of normal, 2 is extreme, but 3 is very extreme. So not many stocks are likely to do that. So in all probability, the stock would not reach that strike price that you're looking for, and those options are going to expire completely worthless. So again, based on probabilities and using these standard deviation forecast tools, there's a less than a 3% chance in this example that Tesla is going to reach 290 by expiration and make this a profitable trade. So in order to make money in this kind of out-of-the-money option kind of trade setup, you need to be very precise on your market direction and timing, or you need to be very, very lucky. So that's going into it. Now, here are your kind of normal standard deviations, what they look like, just kind of get a reference in the field. So here's your kind of what I refer to as normal price move. That would be 1 standard deviation, 68% probability of the time. That's where you're going to have your price range. So that's a normal potential move. Now, 2 standard deviations is 2x, and then 3 is like a 3 delta. So when you're looking at your deltas, you can kind of equate it to 3 standard deviations out would be a 2 or 3 delta, 2 standard deviations about a 5 delta, And the one standard deviation point on each side that's about a plus 16 delta and a minus 16. So basically when I'm looking at options to kind of analyze them quickly, I look at the delta, and if I see it, it's got a 16-20 delta, that's like a one standard deviation point. So if you're going in and you're having an option trade and it has a 20 delta that you're looking to short that strike, that's going to start that trade out theoretically with an 80% probability of success. So that's where we get the name for probability trades when selling option spreads. So if we look at this Tesla, here's the Tesla 25 November. So this is 20 days out. So in this example, you see the 205 strike here for Tesla is going at 12.30, 12.90. So it'd be $12.90 per option contract. And you see the delta is 59 cents, or not 59, but 59. All right. So basically a 50-50 chance of either price being above or below. Now, when you go out to that 290 strike right there, you can see the bid offer is 15 cents to 18. So that'd be like $15 per contract. And the option delta on that is 2. So the probability of this trade is only a 2% theoretical probability that price can get to 290 over the next 20 days, or the opposite reciprocal is 98% probability that price will stay below. So you're going into this trade with a low chance of winning if you're buying those options, but if you're selling those options, you've got a huge probability of winning on that trade. So that's the cool and exciting thing about it when selling options. So again, being close means no cigar in this kind of trade setup. So imagine Tesla, it got to $238 during the 20-day period of your option lifetime, but you could pat yourself on the back for being right about the direction the stock moved. But since you were wrong about how far it would go within that specific time frame, that option series, you're still going to be a loser. And it's always painful to have these kind of losing trades. And especially if you don't know what you're doing going in, you're looking for big trouble. So that's why you want to understand the concepts of options and understand the components and how they price out and work. So here's the example. If you were to be on that buy side and you came out here and you bought 1,380 contracts and you paid 15 cents or 15 bucks, and it got to 238, not to 290. Here's your 290 that you're shooting for, but it only got to 238. Well, you just lost $20,700 on those options that you bought, right? So you were excited to you thought you were going to make 130 or whatever it was, but actually there's a probability of 98% going into this trade that you're going to, have a 98% probability of losing. So that's a kind of a stupid one to go to on the buy side. Now, based on this trade example, a real better goal for every trader or investor would be to select trades based on what's going to give you the most consistent positive returns and not that big one-time winner. So we want to be in the game, and we want to be consistent on our kind of equity curve. And by doing this, we're looking to really kind of look to, kind of hit singles and doubles, and occasionally you're going to get the big home run. But when we're doing option selling strategies, we're hitting those singles and those doubles. And a lot of times that's going to give you more consistent performance when you're looking at these kind of higher probability setups. So this kind of consistency is going to be derived from making these high probability trade bets using reliable data and the facts and the statistics that you have. So where there's a big disadvantage, such as the one you saw on the buying scenario, look at the flip side of the coin and you'll see the equal opposite advantage that you get on the sell side. So in this case, if you were the seller of those options, that's going to give you a huge advantage over being a buyer when you're looking way out of the money like that. And again, all the professional money knows this, and they want to take advantage of this kind of sell side. So, as a seller, all things in the Tesla example are going to be the same, but in your favor instead of against you. So if you were the one selling those options to the buyer, those $290 calls, you brought in 15 bucks per option contract, and you went into the trade with a statistical winning percentage probability of 98% when you set up that trade. So that's a huge advantage going in. So 15 times 1,380 contracts, you would have made 20,700 on a 98% probability winning on that trade. So this is what, the professional money wants to take advantage of, and this is what, you should be looking at as well. So it's great for income, profit generation, but also when we're selling, we can also use it for hedging. So here's the other side of it. So if you were to have sold those options and you sold and brought in 15 bucks on 1,380 contracts, you made the other side of that, the 20,700. So that's way starting out here. You started out with a 98% probability. So that's why we want to look at these kind of probability trades. And we don't have to just sell options. We can also do spreads where we're selling and buying, combining the two together, which I call mixing and matching. And we can make some really incredible kind of trade setups and structures. So knowing when time to sell, that's another key component is your timing. So I always talk about, what makes a profitable trade. It comes down to direction, timing, and then managing your risk. So you want to have a really good kind of some tools that you can use to really gauge the market. When is best to sell, or when is it best to buy? So we're going to look at a couple of tools that I use to do this. One is what I call my cycle reversal indicator, and the other one is an extreme range band indicator that I put together. And these two tools together are great for picking, when to sell calls or puts when things are starting to roll over, or when a cycle is starting to shift down or up. So that's where you can really get the timing component down to give you that big edge. So here's a current example. This is a Netflix, and this was what I call a cycle high reversal trade. So on the weekly, Netflix was coming in. I'll show you where it is. It was coming into a 200, let's see, I think it was a 200-week moving average, and we were at what we call the average true range. So this blue line here is 3 ATR, 3 average true range from the mean. So the mean is right here, this yellow line, that's a 21 period moving average. So this is basically 2 average true range ATR, like standard deviations above. All right, so that's getting very extreme. So the white line is 2 ATR, the blue is 3. So when we get to 3 ATR on a daily or a weekly, that's getting really what we call stretched or extremely kind of overbought. So let's pull this up. I'll show you here. And this is what I call the extreme range band indicators, but it's great for indicating when it's a good time to sell. So if you look here, this is, let me put this on Netflix, 1 second here. So here's Netflix, okay? So see where it got up here. This was, let me put the weekly and you'll see it came up to key moving average, which gives you a potential area for it to fail at. So this is the 50 simple moving average. So this is a 50-week period moving average. So you can see how this is also 3 ATR on the weekly. So very, very overbought, very overstretched. So the indicator tool is great because it's kind of a forward-looking tool. So when we get up to the 3 ATR, like you see right here, and the lower study is my reversal indicator, and when the reversal indicator, which is white, crosses the moving average of that indicator, that generates this arrow, which is your sell signal, if you want to take it for timing and entry for selling a reversal, okay? So this is what we call a reversal. And this one is going from a bullish reversal to a negative downside reversal. So that arrow pops up at 3 ATR, high probability that security or stock is going to start getting exhausted. I call this buying exhaustion. So you get a lot of buyers that come in here. It's kind of like a dominoes or kind of a musical chairs. Everybody's buying, selling to the next person. Party's great as long as somebody's buying it from them. But once you start running out of buyers, you get this thing exhausted, and that's where you can turn into that reversal. So it's a really great tool. You can see the last time this was on a daily, that was a great signal. And you can see the last time it was this extreme for Netflix. We have to go back quite a ways. Let's take a look here. The last time it was 3 ATR was right about here. This was back in August. Let me blow this up a little bit more. So right about here. And again, look at this signal. All right, so we had two, you get a reversal here, reversal. So typically you can get 1 to 2 to 3, but look here. So here's your 3 ATR, you get the reversal here. Does it go any higher? No, it starts going sideways, so it can go sideways, and then you finally get the buying exhaustion kicking in, and then it starts to come off, okay? So that's a really good, that was a good one on Netflix, and we actually did set up a credit spread on this. So the tool's great because what you can do when you get this kind of reversal signal, then what I like to do is you look to sell your out of the money standard deviation type setup. So you go out here when you get this reversal signal, high probability that the market's going to stall. So you go out and you sell a 20 or 30 delta out of the money. So it gives you that probability trade. And you're just waiting for this thing. It could turn sideways for a while and then turn down, but it gives you a great timing edge and entry. So you don't have to be as concerned if you're just, nakedly set, like, let's say you're, right here, you just, naked sell a call or put here, you don't really have that great edge. So that's what I like about it, that edge that gives you for, selling and constructing these types of spreads. So that's one example. That's Netflix, cycle high retracement. Here's one on Apple, and this just happened as well. This was on the 1st of November right here. You see the reversal came, and Apple started to stall. Now this is on a daily time frame here. So this is only 2 ATR. So Apple has a reversal there, reverse there, came off. So I'll pull up some other ones. You can see Apple on past ones as well. So it's just one of my favorite tools that we use, this along with momentum, to give us this kind of timing edge when things are going to either turn over or turn up. So we use it both ways. So if we look at Apple here, you can see here last time we had up to 3 ATRs right about here. This was back in August. You see how it got up to the 3 ATR reversal signal right there, came back down. So this thing works just really, really, really well. So you just go back and look at example after example. So that was Apple, just to give you an idea there. And here's one more. Here's gold, GLD. So we're getting a cycle low reversal now on the weekly. So this is starting to look interesting here from a buy standpoint. So we haven't had GLD or gold with this signal in quite some time. So GLD, this is one to be looking for next week. We'll look at this. So when we look here at GLD on the weekly, you can see it's come down to really hit hard, right? So it came down here to 3 ATR, had a reversal here. See the reversal right there, and moved up from 158 all the way up to 168 and then failed. Now we just had another reversal right here. Okay, so we're starting to get a number of reversals. This is the weekly. This is a really positive sign. So this is going to open up maybe some good trade setups potentially for gold, GLD, in the days or weeks to come. So that's a look there. That's a cycle low reversal on the weekly. Now let's take a look here. I thought we'd take a quick look at the markets and then move on. So I wanted to kind of give a rundown here. So let's take a look. We'll just use the S&P 500 SPX, just kind of show general trend and where we are. So a couple things are going on right now. Everybody that's here, I'm sure you're aware of the different fundamentals that are going on, the inflation, the Fed, all that kind of stuff. But there's also a lot of seasonality strength and cross currents that way with seasonal trends and stuff coming up that I'll show you in a minute. But when we first go out here and just look at the markets using the S&P 500 SPX, you can see that what I like to do is look at the momentum of the market and then look at the trend. So you can see it's just been trending down, right? And then you want to look at, see where your moving averages are, where are the key big moving averages. So you can see with the S&P 500, we've got potential that, it could rally all the way back up here. The big first major resistance would be right here, about 4,100. That's the 50 period moving average on the weekly. So this will give you an idea, but you can see the trend is trending down. As long as we're staying below these trend lines, which are these automated trend lines based on moving averages, the trend is still down. Now within these kind of trends long term, or even if you go macro, so go macro trend, which is the monthly, you can see we're still in a major downtrend. So you see momentum cycle 1 and 2 that I use are negative until these two indicators, cycle 1 and 2, until those go positive, you're not going to have a bottom to this market. So you can go back with these indicators all the way back to 2001, 2008, 2009, and you can see that the market, this was a really great indicator for the market bottom. So here it was back at 2007, 2008, hard down move, right? So this is a monthly. So here's cycle 1, -2. Now cycle 1 went positive here June of 2009, and then we got a confirmation cycle 2 in October. So you can start seeing when you finally get cycle 1 going positive, this is where you can start looking for a market bottom. I mean, a big term, long-term macro market bottom. So we're not there yet. And you can go back to 2001 and see exactly the same. Came down, and then you had cycle 1 positive, and then confirmation 2. The market bottomed right there. Basically, you call it July of 2001. So based on the macro, we're not there. Now we're getting a kind of reversals back up here. When we look at the daily, we're starting to see some potential for a little bit of a bottom, and you see cycle 1 is negative, but 2 is positive. All right, so these are kind of where we are currently. And then you can break down, look at the NASDAQ, but we're still in a downtrend, but we're getting, always potential for reversals up or down, and playing those cycles. But here's the big thing that's, I think, going to have a potential impact here. The markets are super kind of potentially are bearish in a bear market, but there are these cross terms or cross currents that we're currently coming into. So this is the S&P 500 midterm election year seasonal pattern since 1946. So you can see here, if you look at the blue all-term midterm years, so you can see this started turning up in October and trends really hard in through December. So here it is with the Democratic presidential midterm, okay? So this is a really powerful seasonal potential impact to the market, these midterm elections. And I think the market right now, there are a lot of institutions, the market's looking at this. I mean, these go back a long way. So these statistics are in the market. And then we've got the negative statistics of the fundamentals with the Fed and inflation, et cetera. So longer term, we're still, I think, bear market, but, we could get some pop to the upside here in the next week or two, possibly. And here it is these are seasonality chart continuation patterns. You can see the same exactly thing. These are the actual seasonals, okay? So the market tends to have a seasonal low right here on the 28th of October, which we got. Then it'll have a kind of a cycle high back up, and you'll have a kind of cycle high right around November 7th. So that could, seasonally be, Monday or Tuesday. Then you have a potential for sideways to pull back, and then you have another really good cycle low. The big one is right here. So you get about the 20th of November, 3 weeks in. Then you have a pretty good potential for kind of that seasonal trend through Christmas to the upside. So these are things to be aware of in your trading, kind of know the seasonals and kind of some things that are kind of currently in the market right now. So let's go back and look at step 5, which is selecting the right option strategy. So let's take a look at the ones that we can choose from. The pointer, I can't make it any, yeah, I can make it larger. Hold on. So let me see here. Is that better? I can make it thicker. All right. Okay, so let's take a look at the different strategies that we're going to want to possibly use. So, in my opinion, the major goal of every trader, you should be looking to select trades going to be based on what's going to give you the most consistent returns over time with low defined risk. And again, not always looking for that home run. So we want to be looking for, singles and doubles, and occasionally you get the home run, but we want to stay consistent in the game and stay in the game. So the best way to do this is to understand and know what the different low risk kind of option strategies are out there and available, how they work, and then select the ones that's going to be best suited for the market environment you're trading. So let's take a look. So these are the top option selling strategies. We've got the vertical credit spread. We've got what we call the iron condor spread, a long condor, and what I call opportunistic hedge trading management. So we're going to look at these kind of 4 spread trades that I really like to go to, more geared towards the sell side strategies. So the first one is, and the most popular, will be just a credit spread. So it's kind of an income strategy. There are 3 types of credit spreads that you can use. And these are, again, what we call probability trades based on those probability statistics I showed you. So we've got the bear call credit spread, so used for kind of more downside bearish moves. Then we've got the bull put credit spread for upside moves. And then the combination of those 2 is what we call the long iron condor. Okay, so these are the 3 kind of primary credit spreads that we can use. So when we look at the bear call credit spread, it's going to be one that you want to use if you think the market's got a probable direction to maybe go down. So you're basically selling a call while at the same time buying another call with a higher strike in the same series, same month or same weekly series. So this is what we call a bear call credit spread. So the key concept in your maximum value of the vertical spread is going to be equal to the difference between the 2 short strikes. Okay, so the seller of the credit spread will have a limited profit and a limited loss. So you have the spread. So if you just sold naked calls or naked puts, you've got potential for big profits, but also the potential for unlimited losses. So that's why it's best to use spreads. So depending on which strike that you use, you're going to be taking advantage of that time decay to help this position out. So it's really going to be based on time decay, and then also volatility decay going into option exercise or expiration. So the bear call or bull put credit spread can be used to make money over time, even if your stock stays stagnant. So you don't have to be perfect on the direction of the market. So when we look at the vertical credit spread, here's a good example of kind of the basics of it. So here would be like your short a call here. Okay, so this would be, if you look down here at 1020, so you're going to be short this call at 1020. And then if you want, that could be a naked, but you're going to have unlimited risk. So then we're going to buy another call above it to offset and cap that risk. So we're going to be short here the 1020 and then long the 1030 behind it. So if you look at that, that's a $10 wide spread, which would be $10 times 100. So that's a $1,000 wide spread, okay? In this example, bringing in $200 credit. So that is your profit, is your credit received. All right, so typically this could be, what I look at is maybe selling a 20 delta. So this might be yours going short, and that was a 16 to 20 delta. Okay, so going into the trade, that's going to give you a probability trade of 80% probability that price will be below 1020. So that's why you get such a smaller return. So if you go through this, you bring in a credit of 200, your potential risk is the difference between your spread of 1,000. So your potential risk is 800, right? So that's your risk, and your profit is the credit received. So that's what we call a negative risk ratio, okay? So you're risking $800 to make 200. So you'd say, well, why the heck would I ever do that? And it's because of this, because theoretically, probability-wise, if you set this trade up and you had sold that short strike with the 20 delta, you're going into the trade with an 80% probability that this trade will end up being in your favor. So that's why you get this return of 25%. So that's really normal, 25, 30% returns on these types of credit spreads are the norm because of the probability of, that you're starting out with a higher probability of the trade success. So that's a vertical credit spread. And here's an example. This was the Netflix credit spread that we did. So this was, again, set up basically based on this indicator. So we had a cycle reversal coming in here. So set up just a credit spread out of the money. So sold the 315 short strike right there. So you can see it was trading right about here, and then sold that, about 20 delta short strike up there. So here's what that looked like. Now, it's not a huge winner as far as dollar amount, but the probabilities and the percentage on your return is within the norm. So here, if you look at this spread, this was selling short the 315 strike here, right here, short the 315 call, and then long the 320. So this was a $5 wide spread. Now brought in from selling this credit spread, brought in $95, 95 cents, $95. So that's your potential profit. But the reason that's a very small profit potential is because this was going in. This was about, I think this was about a 19 delta. So it was really pretty far out of the money. So going into that trade, this had a 19 delta. So that theoretically gave you 81% probability that price would be below 95. And this one worked out to be that way. So the price came off real hard. So that's the other great thing. If you look at this indicator, this is the one, I like to use this indicator for selling credit spreads, okay? Because we get a bigger edge. You can see it paused here. It could have just gone sideways, but it went down hard. So that's typically what's going to happen. So in this example, it ended up with on Thursday, it was up 92 bucks or 23% return in 3 days. So that's a look at a credit spread and how it could be used in that situation. Now the next one is your bull put credit spread. So it's going to be best used if you think the market's going to go up. And so the strategy here is you're selling a put, out of the money below the market, while at the same time buying another put with a lower strike in the same series, same option series, same monthly or weekly series. And so here's an example, say for Apple, if you did a bull put credit spread here. So Apple in this example was trading at 157 bucks. And so thought the bias of the trade bias is for the upside move. So went out and shorted, sold the 149 put here. Okay, so this is short the 149 put right there, and then below it to cap the risk, bought the 144 put right here. So $5 wide spread. Okay, so short here, long here. Okay, so you're capping your risk. Now brought it into credit of $105. So the max risk would be the difference of 500 less 105, so 395. So if you kept that full $105 premium, this is a 26% return. But again, if you thought about, okay, if you sold this put and had that put when you sold it was a negative 20 delta, something like that, you're going into the trade with 80% probability that price will be below 149 and you'll have a winning trade. So that's a kind of an example there of a put credit spread. Now the iron condor is when you combine the two together. And these are great because we can leg in, leg out, or just put it on all at one time. So it's the combination of a bull put credit spread combined with a bear call credit spread. So there should be equal distance between each strike price, while the underlying price at expiration should be between the two credit spreads. That's where you're going to get your max profit at expiration, between the two credits of the short strike. So the key concept again is the long iron condor is ideal for using if you're a premium collector wanting to minimize your losses if the stock moves adversely against you, because in this situation you're going to have a credit spread for a call side and put side. So if the market was to move up, you can close out the call side credit spread and leave the put credit spread on and make profit there, etc. So you get that offset. So it can be broken down and viewed as two different trades. Again, the bull put credit spread and the bear call credit spread. So it's perfect for laying in. So a lot of times what I like to do, and this is what we're looking at when we did the Netflix trade, the kind of the trade bias and the logic that I look at is, okay, first, if you have something like Netflix and you get the indicator showing that it's starting to stall out, buying exhaustion, typically, so what I would do in this example, this is what we did. We sell the bear call credit spread first, instead of doing a iron condor at the same time, so selling a credit spread here and buying a put spread, we wait on selling the bull put credit spread until we get kind of more of a bottoming action. So you can see it rolled over here, so you can just stay with your call credit spread. And then, you know, at some point, if you want to, then you can sell the bull put credit spread further out of the money. So that's one way you can do it, leg into it, or just do it all at once. You know, so if you think it's going to be in a sideways action, just do it all at once. So here's an example. I'll show you in a minute of that. So when you feel a stock's going to trade in a tight range between, you know, two strike prices and stagnate, that's the perfect time to set up the iron condor. So also if you get that decrease in implied volatility. So here's again, and this is just, if you break it down, you've got two credit spreads: short a call, long a call. Short a put, long a put. So two credit spreads. Okay, so we're going to look at the long condor. So it's a different animal. So there's the iron condor and then just a regular long condor. So the long condor is going to be the opposite. I'll show you that in a second. So if it goes out between the two short strikes, you keep those max credits, and but you still have a cap trade. All right, but it's again a probability trade. So here's a kind of an example of one that we set up not too long ago. This was on Google. So it was trading sideways. So it had a breakdown right here. It broke that 50 simple. And so it was trading right about here. We were looking at the support resistance levels. And so set up this as a long condor. So sold the short strike was at 118. So you can see how far out of the money this was. Sometimes if you can get way out of the money, you know, you've got a higher chance of that staying with under that strike price. So it was trading right here. So sold that about 1 standard deviation out of the money here, the 118 strike, and then sold the 105 strike. Okay, so at the time, those were about 1 standard deviation out of the money. So then here's what it looks like. So in this example, you've got sold the, you can see down below here, so it says the 9 September 105 put short, the 101 put long. Okay, so you're short here, the put here at 105, and then long the put below it to cap the risk. So you're not, if this thing just goes, you know, straight down, you know, you're capping your risk. And then you bought that one below here. All right, so for doing that, brought in $40 credit on that side, okay, and then sold the call credit spread. Again, you could do this all at once or leg into it. So then sold the call credit spread, sold the 114, bought the 118 at 62 cents. So here sold that call there, bought the call here, brought in $62. So on this trade, we had a total of $102 of potential profit. Okay, so we had $102 credit, and then our risk is the difference, the spread width less that 102. So 400 minus 102, the potential if we got it totally wrong would be to lose $298. Okay, so if it went out here at expiration below that strike, the 101, or above the 118, you lose $298. But if you kept the full 102 on this trade, that's a 34% return. All right, so again though, but a probability trade, you're going into this trade with the 80% probability that price will be below 115 or below or above that 101. Okay, so that's a kind of an example of what the iron condor looks like. So done for, you know, range bound type of market sideways action. Now the third one is the long condor. So totally different animal, but looks the same when you look at the profile, but a different outcome, much better, higher returns. So this is one of my favorites. So by combining buying and selling options together, the vertical debit spread with vertical credit spread, this is what makes the long condor. So when you remember, the iron condor is two credit spreads. You'd be a put credit spread and a call credit spread, but this one has a debit spread plus the credit spread. So moves the vertical credit spread short strike further out of the money, and this gives you a bigger profit zone. You've got positive theta. This gives you positive theta trade, which is also great. And I like to use these for swing trades, 1, maybe 2 weeks out. Gives a really great high return, very low capital at risk, great for hedging. This is one of the go-to hedging kind of strategies that I like to use. So you can see the profile looks like just that iron condor, but it's totally different, because what you're doing here, instead of with the iron condor where you're short a call credit spread and a put credit spread, that's an iron condor. This is a long condor. So the long condor, we are going to have two spreads together. We're going to have a short, we're going to have, in this, if we did a long call condor, we'd be long a call debit spread, and then we widen the strike out and short a credit spread against it to reduce the risk and reduce theta. So this would be a long call condor, or you could do it with puts. Either way. So you could do this with puts. So you could be long a put debit spread, thinking the market's going to go down. Okay, put debit spread, and then you could be short a put debit spread below it and have a big range between the two for your potential profit. So you get a bigger profit from the debit spread side, and you get the credit spread side additional profit, plus that's going to reduce your theta and tend to send you to a positive theta trade. So let's take a look at how this works. So here's just a really clear example. This is a long call debit spread on Lockheed Martin. Question, why would you pick one or the other? Yeah, you can definitely do these on crude. You can do these on anything, Laurel. So the reason I would do, okay, so if you're in a range bound situation with thinking the market's not going to move much, that's when you'd want to do the long iron condor. Okay, so let me just pull up a notepad here and just kind of give you a better feel for this. Okay, so if you're in a market environment where the markets are just kind of churning sideways, so let's say the Google example or something. So we have a nice, fairly, I mean, you never totally know, right? But if you get a lot of upside resistance, it could be moving average resistance, price action resistance, and then you also have a lot of downside support, right? So you can define a channel. Okay, so in this situation, you want to play the range. It goes up here, you could go short, comes down here, you go long, but you don't, as long as it's not breaking out, you don't want to do an iron condor in a price pattern where it potentially could break up or down. You want to do this if you think it's range bound. So you go out here and then you do the iron condor. So you think it's range bound within that range. So here, then you sell a call, buy a call, so call credit spread. Think it's going to go up here and then fall down, or think it's going to come down here or not even get close. You think it's just going to churn within these price points. And so there you sell the put credit spread here. So you're just looking to bring in premium from both the call side and the put side. So it's a great way to play that range, okay? Now the other one is the long condor. Okay, so if you're in a situation here where you think typically, let's say what this one is great for, if you have a move and you have a potential for a bigger, stronger move up, but you think there's a lot of overhead resistance above that you think will cap the trade eventually. So you think, okay, initially we can get a nice pop, but then we're going to run into that resistance. So not like a iron condor where we think it's going to just turn sideways. We want this one to actually have some movement but we can cap the upside, bring in more premium from selling that credit spread, and then reduce our theta. Okay, so we do this what calls our put. So it's that kind of environment. So think of a situation where you think, okay, I like the price potential movement, but I think it's going to be capped, so we can cap it with the by selling that credit spread against it. So, for example, here was, you can see Lockheed Martin, the 307.5, 310 call debit spread for $99. So long a call, short a call, and you leg it or do it all at once. And here's your credit spread. So short a call, long a call. So shorted the 132.5 call right there, bought the 315 call here, brought in $40. So the original debit spread was $99 less 40. So you're got this long call condor now with a max risk of $59. Super great low risk trade, right? And potential, if it goes out between the two short strikes of your spread, this would make $191 on your total risk of 59, so 327% return. So that's the thing I like about the condor, this condor, not the iron condor, the potential for big profit. So again, think about the difference between the two. So if you do the long iron condor, okay, that's what I call a credit spread. So if you do that, okay, just think of that, the long iron condor is a credit spread. If you do that, let's say you get $40 credit here, $40 credit here. Okay, so the max you can make on that would be your credit of $80. Now the long condor, though, you can see from that example I just showed you, it's got a debit spread side and a credit spread side. So, you know, you might make on the debit spread side, you might make, you know, $150, something like that. And on the credit spread side, let's say you had 40, you make 40, so you make potential of $190 on your risk, which is, you know, you can see from that example is super low. So that's the beauty of the long condor, okay? So, you know, typically 200, 300% return type trade. So again, it's, in this example, along the 307.5, 307.50 call, short the 310. So it did that for $99 debit cost. And then the difference between the spread width would be your potential profit. So if you're just taking this down there, you can see that if the debit spread closes above, you know, that 310 strike here, you're going to make the profit on that would be, it's a $2.50 wide spread less 99. So this would make $151, okay? So that's a lot bigger than just the credit, right? And so this one then, this one, the 312, 315 brought in $40 credit here. So there's your potential for your max profit of 191. So if it trades between your two short strikes at expiration, in this example, you'll make $191 on that risk of 59. That's a 323% return. So just versus if you did the credit spread, the iron condor, you're like, we looked at the Google trade, the return was like a what was it, 26% return, something like that. But it was a, you know, probability trade. So one is for range bound, the other one is range bound with potential, you know, pop either up or down. So iron condor is two credit spreads together. Long condor is a debit spread and credit spread together. So using a long condor, you have, okay, so if you're doing a downside trade, you know, if you think the market's going to go down and you want to do, you would do a long put condor. If you think it's up, you do a call condor. So we'll talk about a little bit more here in a few minutes as well. Now the fourth one is what I call opportunistic hedge trade management. This was actually a term coined by one of my members, Rick. But it's so true, because by understanding the, fundamentals of options and spreads, we can really do some great things for hedging. So here's a really good example of a hedge that we did. This was what we can do is turn a trade into a free trade. So when you're trading, especially trading options, I always talk about think 2 or 3 steps ahead, okay? So always be thinking, okay, what if this happens? What can I do to the trade? Think of, like playing cards or playing chess. You're always thinking about the next move. So in this one example, we're looking for a downside move, okay? So QQQ. And so on the first, on the 28th, we set up a put debit spread. So the initial trade was breaking down here, but then what you want to do is think 2 or 3 steps ahead. So in this example, QQQ was trading at 365. Now, if it broke down, where can it go? That's where we use our Fibonacci levels, moving averages, what I call price target mapping. And so then we can look at a level that it can go to. Say, for example, we got in here at 365, but we knew that down at 355 down here, there was support. So it could maybe bounce here. So with this one, what we did was when it got to the lower price target that we had right here, what you do is typically we'll take some profit from this put debit spread, but then adjust the balance. In this case, we adjusted the balance into a long put condor. All right, and then we were able to sit with the trade because we had no risk in it until the expiration and just kick back and have no stress and see what it does. So it ended up making close out at 359.67. So let's take a look at how you can take advantage of these types of moves to put yourself into what we call a free trade, which is literally a free trade. So in this example, trade 1 was the original trade. So we were long the, hold on, I'm gonna have to do a little smaller. So here we were long the 364 put short the 360, okay, put debit spread. So long the 364, now it's not wide enough. Hold on. Okay, so we're long the put here, short the put here, okay, nice put debit spread. So this cost was $121. So this cost $1.21. So the spread is $4 wide. 400 minus 121. So the potential profit on this, if at expiration it closes at 360 or below, you'd make $279 or 230% return. Nice return. So, risking $1 to make $2.30. So fantastic. But with this kind of adjustment, what we can do when it crashed down to that 254, 255 level, we sold a bull put credit spread against it, okay? When it crashed down way out of the money, we sold a bull put credit spread against it. We were able to bring back all that debit cost that went out at 121. We were able to get a credit actually of 140. So that offset the cost there and actually put us into the trade for a credit. So this is what you can do if you're just aware of what's going on and have a kind of a game plan. So then basically what it came down to was trade 2, when it was trading at 354.53, we sold the bull put credit spread at 354, 350, okay, $4 wide, brought in a credit of $141 per spread. So you can see then your adjusted trade went to a free trade. So we were long the trade 1, 364, 360 put, that cost $1.21 to get in. But then when it crashed down, it was trading down around that 355 level. We sold the bull put credit spread here, the 354, 350, brought in 141. So now we've got this trade on, no risk, $20. So if it just blew to the upside, we still make 20. If it blew to the downside, we make 20. But if it goes out between the two spreads, this trade would make $420 on zero risk, and that's what it did. So it went out trading right here, so right between those two short strikes. So you can see we have the put debit spread, the 121, and that went to $4. There's your profit there. and then had the bull put credit spread, a credit of 141 that went out worthless, so kept the 141 there. So there's your profit on that trade, the combination of those two. And with this, you get a positive theta, which is great with big potential profit potential. So here it was 420 max profit, risk of 20, or actually a credit. So if you'd like to learn more about how to master these kind of option selling strategies for income, profits, and hedging, we'll be doing a workshop covering all this and much more next Saturday. All right, so I've got a great setup and program for you here. This will be next Saturday. So how to capitalize on selling options for income, profits, and hedging. And yeah, you can use Tasty Trade. Yeah, they're great for the spreads. So this will be start next Saturday, the 12th, part 1, 11 to 2. And then we'll finish up on Monday with a 5 to 6. But you're going to get a 4-hour course. I always tend to go over because, you know, I'm in there to answer questions as we go. And there's 7 really great enrollment bonuses for everybody here today. So let's go through with the package, and then I'll take any questions, or we can look at other trades. Let me give you the link here real quick to use. So I've got the 2 packages. One is just the course and all the goodies. And then if you want to combine that with my alert service, that's package 2, which has been really a great service that hopefully everybody here is a member of. So use that link there. So that's everything you'll see. It's $197. That's a one-time payment. And let me make sure that link works here. Yeah, so just click that link or copy it and paste it, and you'll get this pop up. And so you'll get this everything, how to trade on certain market selling options, $197, cost of the price. And so here are all your bonuses listed. And also, if you want my trading indicators, you can add those to it as well. So 195 there. So that's that link. And so let's go through what you're going to get. With this package and package 2, you're going to get my indicator software. You're going to get my cycle reversal indicator, my extreme range band indicator. Now on the website, these are both going for $197 on my Power Cycle Trading website. And then you're going to get my exponential moving average cross. And so we'll go through in the course how to use that and how that works. That's $97. Then you're going to get my new price mapping. So for putting your target prices together, I call that price mapping using Fibonacci and some other things. You'll get this course as I just did this one in October, so you get that. It's $297 on the site. Then you'll get my trading club membership for 30 days, excuse me. And hopefully you'll renew. It's $97 if you want to do that. So you can start this when you want. You don't have to start it, today if you buy the course. You can start it, whenever you want. Just give this email if you want to wait through the course and then start it, you can. Now, if you do my next package 2, you're going to get the trading club for 4 months. Okay, so then we'll get a Q&A as a bonus, and my option tutorial. So this is another option guide with videos. So those are the key bonuses. All right, so you get all that stuff, and your max price is $197. So it's powercycletrading.com/sell the number 1. So here's the link one more time for you. So use that. Now, if you want my alert service, which has been really, really great, knock on wood, we've been, doing really great with the service. So if you're looking for more help and you need more guidance, more kind of, I'd say, mentoring in your trading, then this is a great package for you. And it's a very reasonably priced, low price package. So this one will include everything at that course package 1, but you're going to get my 4 trading alert services for the next 3 months. Plus, you'll get my trading club membership for 4 months, so an additional month there, and everything in course package 2. So with this, you're going to get, if I have a butterfly or a long condor trade alert I send out, you'll get that. If I have a calendar diagonal, you'll get that. Or a breakout or a credit spread or reversal trade setups, you'll get that. Or earnings. So you get these 5 different types of trades that I might send out. And this is all covered for 3 months. So if you break this down, you can see that this basically comes out to $400. And so over 3 months, you're looking at a service here where you're getting all this, the service for $133 per month. If you break it down that way, that's a great deal. Not only are you getting this 133 per month, but you're also then getting the course for $197. So with this, you get all the alerts for 3 months, the trading club for 4 months, the course package for here at 197. If you bring it down on a monthly basis, pulling out the cost there, that's 133 a month. So I think it's a really fair, great value for everybody here, and you'll make your money back. Some people have made it back on one trade, or you make it back, in a week or 2 weeks or a month, whatever. So it's a great service there that you can get jump into if you'd like. So with this, I call it the Elite Open to Close, because I'm doing everything. So it's a open to close service. I give you the entry, I give you the text alert on the entry, any adjustments, any profit take, etc. So these are always being alerts sent out to you for that information. And these alerts go out really fast. I use a service called Telegram. And so as soon as I put it in and knock it out, boom, it's out within a second. So we just did, we had a QQQ short trade that we set up last week. And on Friday, we just did a Nike long. Here it says new Nike long trading at 95.70, et cetera, et cetera. So this one we did a call counter diagonal. So that would have been sent straight out to you. Here was an adjustment we did. Here was XLY. We had a short on that. We did an adjustment there. Here was the QQQ trade. We had a short, then we did adjustment. So very, very defined, text that will go out to tell you what to do. And with this, you'll get the alerts, all four, it could be anything from butterfly, condors, etc. You'll get those for 3 months. Now you can stop and start this whenever you want. So if you go on a vacation or whatever, want to stop it for a week or 2 weeks, just let us know and we can stop your time. So typically, anywhere from 10 to 15 stocks or ETFs per month. And so these are selective trade setups for what I call breakout trades or reversals or credit spread type trades, like the Netflix. And then we do a lot of calendars and calendar diagonals because they're, a great structure for certain environments that we're trading as far as upside or downside, different, timing situations. So may send out a calendar or calendar diagonal. And then we do a lot of butterflies and the long condors that we'll be talking about in the course, and then selective earnings trades. So when these are sent out, you'll get a trading guide for each one. I do a setup video after the market closes telling you why I did it, what we're looking for. The trades are listed and archived. Then with this package 2, it's $597. There's also a 2-pay. Let me give you the link there before I talk too much here, before I bore you to death. Let me give you that link. So there's 2-pay if you'd like to utilize that. It's let's see here. So there you go, use that link there. This will give you all you need as far as the course. Let's make sure that link's working. Yep, working good here. So $597, and with that, you get everything in course package 1, plus all 4 alerts, plus the trading club for 4 months. And there's a 2-pay if you like it right there. Click on that, boom. So that's the link for the alert service. And then we do a Q&A. I do a Q&A every Tuesday live and recorded. So you'll have access to that for the next 4 months. I do a video newsletter every day after the market closes. So you'll have that for the next 4 months. And then access to my virtual trading coaching room for the next 4 months, and discounts on any course or software that I have 60% off. So a lot of great value there. So the trading club, trade rooms open every day. So I'm in there, ask questions to me or show you what trades we're looking at. Anything you need help on, I'm there to help you. Oh, thanks, Laurel. All right, so here's a summary of our Elite Open and Close service. Now these are unaudited, but these are it's kind of a summary of the club, not the club, but the service since I started it. Now I started the first one, I'll show you in a minute, back in 2018. So this was the first service, was just breakout trades, but since then I've added the calendars, butterflies, earnings, etc. So through Friday's date, we've had 530 trades closed out, 411 have been winners, 19 break even, 100 losers. a really high winning probability or winning percentage of trades, 81%. So that's what I'm really shooting for, winning percentage. Okay, so kind of chip away, and then boom, we make a big one. Okay, but want to control the risk in this way is I've really been able to control the risk, looking for winning percentage versus the gains. So you can make in trading, you can make big money, and you can maybe make 50% of your wins, or even less than 50% of wins, still make big money. But you're going to have a lot of drawdowns that way. So I like high winning percentage type trade setups that may be a little bit less on the amount you'll make, but there's going to be some situations where you get the big home run. So I'll show you some examples. Now, here's the calendar diagonal alert service. Started this back in June of 2019. And we do a lot of these because they're great for certain situations. We've had 165 trades closed, 131 winners, 5 break even, 29 losers, 82% win rate here. Really high winning percentage. So that is one part of the service that you'll get trades on. And here we've got butterfly long condor service. I started this back in 2019 here. And we've had 107 trades closed, 82 wins, 5 break even, 20 losers. Again, 81% winning rate. These will be anywhere from potential downside risk of $50 to maybe 200 at the most. So very low risk trades, all positive data. And then the first service I started was the breakout service right here back in 2018. And we've had 157 trades closed out, 116 winners, 6 break even, 35, so 78. So, the trades will be just spread between these different types of possible different strategies depending on what the market's given us. So everything's a little bit different every day, every week, right? And then we have done some earnings trades. We've got this service I started back in June of 2019, and we've had 101 closed out, 82 winners, 3 break even, 16 losers, 84% win rate. These have been trades we've been doing typically what we call double calendars. So here's a little nice note that I got from Pam, one of my members, just sent me this. She said, sending a quick note of thanks that you could maybe pass along to Larry. She emailed it to my assistant for all his fabulous teaching through the years. I truly enjoyed learning from him and the other traders in the trading room every day. I don't think there's a better trader in the world when it comes to option spreads and the other ways to do trades than Larry. Okay, so thank you, Pam, if you're here. Now with the course we're going to do, here's the link again. Here's the alert service link, and then the other link is just Parasol Trading Cell, the number 1. So here you go, Janice. Okay, so part 1, we're going to start out with the option Greeks that are important and vital for these selling option type trades and credit spreads. So you'll get an option selling guidelines. So it's a handout that I'll give you that you can put on your desktop, the guidelines for these types of trades, and then how the option pricing works to benefit and effect that you get from the time decay and volatility. So after you take this course, you'll understand the fundamentals of these option Greeks and how they work on price. Then we'll go through and use the price target mapping. This is a bonus course, but I'll show you how to map out your targets for establishing your spreads, and then how to use your standard deviation kind of a forecast for setting up your price targets using standard deviation. So this is what gives us the high probability directional trade targets, the standard deviation analysis, okay? And then what are the best markets and trading timeframes for credit spreads? So we'll go through that. And then you're going to learn in the course, I'm going to give you'll get with the course, my Fibonacci ratio moving average cross. So this is a really cool indicator that gives you a really good directional signal based on momentum for when we get a confirmation for a reversal up or reversal down. So you'll get this indicator tool. And then we'll go through how to use my cycle reversal indicator and the extreme range band indicator for signaling when it's time to sell. So this is such a great indicator. All trades that I do and that send out are all based on a big important impact are these two indicators together. along with my momentum indicators. But you're going to get those as a bonus for this course. So then part 2, we're going to go through the 4 best option selling strategies, which strategy to use, when and how for income, when and how to use credit spreads for income and hedging. Okay, we're going to have a lot of time spent on hedging using these, how to profit from your time and volatility, crush and time decay from the credit spreads, step-by-step guidelines on when and how to set these up, the trades, and then how to defend them. So we'll go through in great detail bear call credit spreads, bull put credit spreads, the iron condor, okay, and then when to use call credit spreads, when to use bull credit spreads, when to use the iron condor, which market conditions are best for your credit spreads, and which one to trade. So you're going to know exactly when you want to use either of these spreads. So the conditions you're looking for, of the market, and then how to use them, and then the ideal number of days for entering and exiting. So, how long do you stay in these trades? A week, 2 weeks, 3 weeks, etc. And then the 5 must-know rules for trading credit spreads. So I'll have a, kind of a rule-based kind of step process of 5 rules to use for your credit spreads. And then we're going to go into the long condor. So when and how to use the long condor, not the iron condor, the long condor. So when to use it, not to be getting confused with the iron condor. So this is a real favorite, low capital at risk strategy that often delivers trading returns of 200% or greater, and always with a positive theta, no time decay. So big advantage of the long condor, what it has over other spreads, step-by-step guides for, putting these condors together, which are vertical spreads, how that works, how it's constructed, then how to adjust and reduce these trades, using what we can do a broken wing long condor or ratio condor. So we'll go through that, when to use these 2 types of structures. And then part 3 is a big part of the course will be just dedicated to hedging. So we'll go through, a complete guide for hedging with options. So we're going to go to how to minimize losses from losing trades or even make them profitable. Okay, how you can do that using these option hedges. And so the major hot hedges that we're going to look at are going to be these credit spreads we use to hedge out, other core trade positions you might have on. So how, why, and when to use the condor spread hedging defense. And then I've got 5 ways you can defend and hedge credit spreads. So this is worth the course right here. If you're doing credit spreads already and you want to know how to defend them, we're going to dedicate a big chunk of the course here to some defensive strategies to use for your credit spreads. So these are 5 different strategies for, credit spread strategies for hedging, where you can actually still make money even when you're wrong at the end of the day. So spread execution tactics will be covered, so you can enjoy your life and not be glued to the screen all day. And then I'm also going to do one other little part in this course, how you can defend a stock portfolio. So an extra bonus with this crazy market. If you've got a stock portfolio, I'll show you how to use a protective collar hedge and how that works, and how you can structure a real easy way to set up some really quick hedges on a portfolio basis. So this course is going to cover so much as far as hedging and everything you need there. Part 4, tools, tricks, and strategies. What you must know about assignment risk, so we'll cover that. What you need to know about expiration risk and auto exercise and assignment. So try to cover all the bases that you need to know, and then you'll have a trading library that you can go back and look at past trades, which always I think helps. So that's everything you'll get in that course. That just kind of covers the outline of it. So here's from Charles, said, thank you for the wonderful credit spread option course. The class was so thorough and expansive on the immense flexibility of credit spreads. Thanks again, Larry, for all your efforts to help traders. It's so inspiring to hear an option professional with your vast experience helping others up the ladder to a new level of understanding on credit spreads. So thank you very much, Charles. And let's go through the bonuses and then any other questions. So you're going to get my cycle reversal indicator. So this is a 2 study. You've got an upper and lower study. Got this for Thinkorswim, TradeStation, Trading View. So you'll get that, and we'll go through how to use it in the course. Then you'll get my bonus special 2, my extreme range band indicator. So we'll go through how that's used in the course. So it's available Thinkorswim, TradeStation, eSignal, Ninja. So you can have one or all, whatever platform you have there, you can have it. And then we're going to go, so here's, the extreme range band indicator we went over a little bit earlier, what that looks like. And then you're going to get my exponential moving average cross indicator. So we'll go through this in the course, how it's set up, how it's used. So it's basically an exponential moving average cross indicator signals momentum reversals. So this is comprised of an upper study to signal a price reversal confirmation and has a lower study as well. So it has arrows to show you when the reversal is, and it's based on, Fibonacci kind of number sequence. So that's why I call it kind of a Fibonacci ratio moving average cross. So that's what you'll get 3, and then we'll go through price target mapping, but you'll get this bonus course so you can really get into it in great detail. I did this in October. So this is an on-demand Fibonacci course that combines Fibonacci and also using your moving averages, price action support, standard deviation, unusual option activity, all these steps together to put together called price target mapping. So this is what we use for mapping out, okay, where do we think price can go, up or down? And so that's how we can then back into our trade setups. Okay, so you'll get that. Let me see here, I did something wrong here. I messed everything up. Hold on one second. Oh, here we go. Okay, sorry about that. So you'll get that as a bonus. It's a really great course. And then you'll get my Power Cycle Trading Club membership for 30 days free if you do package 1. And you can start this whenever you want. You don't have to start today. So with this, you get access to my trading room every day during the week, 9:30 to 10:30 Eastern. Come on in, ask questions on trades you're doing or trades that we're setting up. So you'll see how those are done. Again, you get my updated videos every day after the close, weekly Q&A, which is recorded and live and recorded. So we do those usually every Tuesday. Got a great Traders Education Vault with good material there for the for all members, and discounts on any other courses or software on my website, 60% off. So you get all that as a bonus there. And then 6, we're going to do a follow-up Q&A, support Q&A. So we'll do this usually the day after the course, and then so you have more time for questions. And then just as part of that support mechanism is the virtual trading room. So you'll have that for 30 days, and hopefully you'll stay with us and renew for another 30 days, or you can do an annual membership, or you might want to do the alert service, which I would highly recommend. And then another option course, basically my option trading tutorial. So 60-page option guide with videos on the Greeks, option delta, more standard deviation, and probability analysis in this course. Okay, so you get all of that, and then delete, open, and close alert service. So you'll get this here, and let me give that link. So if you're looking to put that one together, here's a link for this one. So again, you're going to get 3 months of all my alerts, and then 4 months of the trading club, and everything in course package 1. So all indicators, bonuses, everything. $597. There's 2 pay. So all access to trade alerts for 3 months, trading club for 4, and then selected trades from breakout reversals, credit spreads, to calendars, calendar diagonals, butterflies, long condors, and earnings trades. So a little feedback from that, this from Waleed, one of my members out in Kuwait. He said, Larry, I've mentioned one thing. I'm subscribed to a lot of services who send out trade alerts. Some are good, others are not that great. But one thing that I would like people on this webinar to know is when I get a trade alert from Larry, I do it blindly. And as time has shown me, this man is dead accurate in his recommendations. So I'll show you a few that we've done recently. We've been pretty accurate. Thanks again for the great service. And this was from Scott. It says, after 20 years of trading, I found Larry to be the best trainer coach in the business. I joined for a year and paid for my annual membership fee within 2 weeks, and that was doing small trial trades. It'll be the best investment that you'll ever make. Go with the Elite package. Great group of traders as well. Thanks, Scott. So when I send out alert, I send out a guide. So a lot of members just do their own thing, but I'll always send you an option, trade to do with the alert that I send out. Give the entry level, profit target levels, things like that, what option series to use, stop loss guidelines, etc. Trades are listed, archived. Then with the alert service, you'll get trade setup videos, review of the trade after the market closes. Then I do a video newsletter every day after the close. You'll get that for the next 4 months. Weekly Q&A, you'll get that for the next 4 months. Access to virtual trading room, you'll have that for the next 4 months. And discounts on all courses and software that you don't already have in the educational vault. So again, here's the service, 81% winning percentage. Now here's some other trade examples. The course, the next week course will be 4 to 5 hours. Everything's broken down in modules. So you'll have all the things recorded. I break down the courses in kind of modules like a chapter of a book. So 30 minutes or less. So you can go back and look at very specific things you need. So here's some examples. Here's the butterfly. Here's one. Here, these are just recent. These are all alert trades that were sent out. So you can see how defined these are. So this was one that we did this short on Apple, and this was set up on the 29th. Apple was trading at 145.62. So we did this for a total risk of $74. Okay, so that's what I always look at versus risk. So this was expiration on the 7th October. Had a potential to make a 577% return, max potential profit 427. So here was the alert, said new Apple short trading around 145.62 daily, close below 147, opens the door for potential move lower to 140. Buy the butterfly, the 7 October, 145, 140, 135, put butterfly at around 70 cents. And then I put a summary so everybody can, know what's going on. So some people have had difficulty with that. So it says summary, long 7 October 145 put, short 2 140 puts, long 135. So try to make it super clear. So if you've never traded before, you can actually follow these instructions and do the trade. So here was the trade, went short right here based on the momentum indicators, etc. And then we got out right here. And so this was pretty darn good on this trade setup. So you can see the setup here was targeting, our price target was 140. If you just did the ETF short, you could have made $5.62, 3.85% return. But if you did this butterfly, $74 of risk, you had the potential to make $426 or 577% return. So risking $1 to make $577. So you can see the risk here, potential profit. Now it didn't make max profit, but came very, very close. And let me pull that up real quick. Now a lot of members do their own thing too. So these are just showing the entries. My entries are really pretty damn good. And so here's the trade right here. Went out on the 7th right here, trading right at 140.29. So this was pretty close to perfect. And so it was up over $300. So it went from $74 to $396. So it was up $322 per spread, 435% return versus if you just did the shares, 3.66%. So that's an example there. Here's another one. Here's one we did on S&P 500, SPY. So this was a short using a put butterfly. On the 21st, it was trading at 378.91, so max risk 115. So here you see new SPY short trading at 378.91, market below prior day's low by a butterfly. The 26th September, 377.70, 363 at around $1.10. Okay, so that tells you there. And then here's the entry level right there, momentum down, boom. So this was almost basically a day trade. So we got into that trade and targeting the 370 area, so 115 total at risk, potential max profit 585. That'd be over 500% return. And this one went out right here trading right here at 369 right there. So still had some profit, but we went in and took it off. Markets, moving around. Sometimes you just have to take it. So this was up 240 bucks, or 200%, 208% return in 5 days. And here was the one that we did Valero on a long call condor to show you what this one looks like. This one we legged into, so it shows you the entry and then the adjustment and the exit there. So this one was a long call condor. So it started out right there, the entry on the 17th, it was trading right here, 116.94, then had profit take over the 19th, 25th, 26th, just kind of running through here. So did this with $107 of risk, potential max profit 293, which would be a 274% return, and pretty much nailed this one. It went out between the two short strikes of the spread right there at expiration. So this was a max profit. So this was max profit of $293 on this. So that's a long call condor example. These are again all alerts. And then here's a counter diagonals. Here's one we just set up this week. This was on a QQQ long put calendar diagonal. So you can see here, this was on the 2nd. So new QQQ short trading at 267.76, breaking down after today's Fed meeting and looking for a retest of its October lows. So buy this diagonal, buy the 11 November 267 put, and sell, here it says sell the 4 November 261. So then I put the summary, so if you're not clear on what that is, this tells you exactly. So the summary, long the 11 November 267 put, short the 4 November 261. So we did that. And this thing yesterday, this thing went out up $300 yesterday. Okay, so we had a profit take yesterday on part of that and adjusted the balance. So here was the trade setup on this one. So got in right here on the 2nd, right there. So this is the reversal, a moving average cross indicator right there. You can see that right there, that orange arrow. That's the exponential moving average cross indicator, that arrow. Cycle 1, 2 down. So we went short here, went short using a put calendar diagonal. And here's where it was Friday, profit on Friday. So it was up trading at 260. And let's see, this thing was up over $300 on that. So this is where it was on Friday. You can see it was trading right here at 260.43, right there, just pretty much nailed it. So what we did, we took partial profit. We took profit here, but then we adjusted it to a bigger spread. So we also did an adjustment, which you would have gotten a text alert on that. So here it was, the 267 long November, short the 4 November 261 at 478, went out, it was up 782. So this was up over $300. So still in part of the trade with an adjustment that we did on it. So that was one there. And then here was another one, exactly the same, but we did this one back on the 7th. So look at this one just crushed it. So this one we did just like we did this past last week, but we did the adjustment as well and got more follow through. So with the adjustment, we got short here and then we adjusted right here and took profit the next day right there. So this was actually after the adjustment. This trade is just really hit the home run. So this trade went, after we adjusted the trade, we had our total risk knocked down to $50 per spread. And this trade went out up $784. So this trade was up $734 per spread. That's over 1,400% return. So that's, based on the adjustment part of the trade. So like I said, you get singles, doubles, and then you get these home runs. And here's just one more XLE. This was a long call calendar diagonal, okay? So XLE right here, we traded this for a breakout up and it had a nice move up. So we did this one, we got into this one at 348 and then out at 539, so up $191, 55% return. So those are just kind of review there. So really, a big hard part of trading is selecting the trades, right? And that's what I really spend a lot of time on each and every day, is trying to find these kind of special selective trades. So, you know, it's worth the money if you look at it and break it down. If you can make back, you know, you make back 597 pretty fast, it sure beats you having to sit at your screen all day and at night trying to find trades. So that's what I really like to do, and I've gotten pretty good at doing it. So hopefully you'll take advantage of this opportunity. Really, it's a great opportunity if you want to get into my alert service. Yes, and a question: do you use the scanner to find stocks? Yeah, I have a scanner that I use. Yes, I do. That's a scanner that I use. I'll show it to you real quick. So that's everything. Any questions? I'll pull up the scanner and show it to you. So you can go check out prices on my website, but try to give everything great value to you. So if you go to my website, you'll see everything that I'm talking about here. So you can see my courses, trading software. So if you go here, the trading software, here's one of the scanners I use, but then you'll get these are all the different indicators, but the one you're getting with the bonuses here today are my right here, my cycle reversal indicator, getting that, and all the details. You get my extreme range band indicator, and then if you want any of the other tools, you can get those for 60% off with your discount. So got these for wealth charts, trading view, Ninja Trader, so all that stuff, and then courses, etc. So a lot of good content, and a lot of good stuff there. Okay. All right, Haley. Okay. Well, if you have, here's what you can do. I'll show you. Just use this link here if you like to join us for a retake. 1 second. I'll show you here. So Haley, if you have been with us before on it and you would like to join us again, please do, and use this link here. Okay. Yeah, so the trading alert service, yeah, so if you're going on vacation, you can stop the service. You know, if you're out for a week, 2 weeks, you can just put a pause on the service and then come back, and you're not going to lose the time that you're taking off. Okay, so we make it as flexible as we can. So the question was, if you hold on your trading service on a given day during your vacation, yeah, so you can pause it, then turn it back on, to try to be as flexible as we can. Okay, Russia selling, yeah, makes sense there, Laurel. Okay. All right, that's everything in course package 1, and then course package 2. Just a summary here. You get 3 months of the alerts. Okay, all the different 4 that I laid out for you. 4 months the trading club, and everything, all indicators and bonuses in course package 1. So you get this alert service with everything else, $597. So pretty good deal. And again, we'll be meeting next Saturday, so 11 a.m. to 2 p.m. Eastern, or however long it needs to go as far as getting questions answered and doing all that stuff. And then follow up on Monday, and then everything's recorded and broken down in modules for you. Okay, hold on here. Yeah, hold on, Jay. Here it is. So use that there, Jay. You're welcome. All right. Any other questions or anything anybody would like to look at? Yeah, I'll show you. Yeah, the adjustment we did. I'll show you the. Let me show you the adjustment we did on Netflix. I mean, not Netflix, but QQQ. Pretty crazy day on Friday. Man, we had this trade was up huge, and then the market came back, but we still are in it with an adjust. We did an adjustment on it. So we got. So what we ended up with, we adjusted it to, I'll show you the current. So we had over $300 profit on the initial trade and then adjusted the balance. And so we've got the balance trade here. So here's what we did for the adjustment on Friday. So now we're long, still long 11 November 263. So we rolled down the long 267 put to 263 and then sold the 7 November, that's Monday expiration, 257. So we're in that at an adjusted price of $262. And this went out up 172. So when the market was down here on Friday, trading at 257, this was up over $400. So these things can make money really fast. So that's one that we're currently in. The other one that we did, the other one that we did on Friday, we'll see how it goes. We did a Nike. So we did this as a call condor. See, it started to break here. Here's the volatility squeeze. Broken by that 382 retracement. So set this up. If it can get through this 50 simple, this has potential to move up to 101, then possibly higher. So this was the alert service trade sent out Friday afternoon. So this was doing a call calendar. So we did the 9 December 95 call, sold 11 November 99 at 370. So that one we just entered. And that's about it. We also working on Costco, credit spread, etc. And oil, yeah, oil looks good here. I mean, you know, it's the only bright part of the market, really, isn't it? So it should probably get some more push to the upside. I mean, the winter's coming on. We've got a major volatility squeeze here on crude oil. That looks really good. So if that triggers, we're going to get probably move back up. Here's the 382 retracement. Would not be surprised to see us get back up here to that 105. Could easily get up there and maybe retest the upside. So crude oil does look good. Gold is starting to look good, but gold is so keyed on to the dollar. So that's the thing that you got to really look at. So be watching next week the dollar closely. If the dollar, what I'm looking at is this support area here at 110. So the market had a huge sell-off on the dollar, and that's what really ripped the markets higher Friday when that dollar started really cascading down. But here's big support, so you don't be sucked in, you know, be careful. But gold, based on that, you're seeing a big move starting to shape up on the metals, okay? So you can see gold is starting to look a little bit interesting here. So gold, GLD, GDX. So be looking at these things on Monday. See GLD, GLD, GDX, gold miners. So these will be things I'll be watching, but got to be really aware of the dollar and what it's doing. And so that's pretty much it. And you see the sector rotation where the market money was going up. Meant to show that earlier, but everything got a bid Friday, which is pretty interesting. But you see, you know, if you look at let's say for the last year to date, energy, everything else is down. Look at that. All right. Well, thank you so much, everybody, for being here. Any other questions, feel free to ask, or else we'll call it a day. How many traders are active at any one time with the alert service? Let's see, about not enough that it never has impacted. If your question is, does it impact? It does not, because the things that I typically send out trade alerts on are things that are very highly liquid, high volume. So we've got, a couple hundred, I guess. Just trying to see what we have currently, but with these markets, they trade such huge volume. I don't, look at anything unless it's a big liquid ETF or stock. So, if you look at trading, like for example, we're going to do something on GDX, 46 million shares traded, right? Or GLD. Oh yeah, we did. I forgot we did a short trade on Apple actually on Friday as well, or last week. Let's see, Apple, we did that trade as well. For example, Apple 140 million. So we did a put calendar diagonal on, and we did a vertical credit spread. But anyway, we did this trade. If I can find it real quick. We did this trade this past week as well. We did, actually, I think we did this on Friday. I get them all confused. We did the long the 2D 138 push, sold the 11 November 134 at 340. So those are some current trades. Yeah, Medtronics. Yep. So we're sitting with Medtronics is the other long trade we have. Let me pull that up real quick. So with that one, we converted to kind of close to calendar to kind of buy some time and see if this thing could stabilize. And here was looking like a good breakout, and then we got hit with the rest of the market after the Fed meeting. So we're long Medtronics right here. See, so I'm looking at this support level right here, this kind of 82. So if we can hold this 82, churn, we can adjust this and adjust it, and hope if it gets back to the upside, we still have potential there. So with this trade, we're down on it currently, but we've got it adjusted with a hedge. So we'll be taking a look at that. All right, everybody. Again, thank you so much. Any last minute questions or anybody need the links, please let me know. Yeah, bonds. Yeah, well, bonds, yeah, same thing. Bonds here, let's take a look. Bonds right here. The 10-year, kind of at the top of the channel here. You can see it was pushing, now it's starting to push down lower, so we'll see. We had a pretty decent move up, sitting right there. And 10-year TLT is kind of looking interesting here. So here's the 10-year. So we're starting to get a volatility squeeze here. Cycle 1 and 2 are starting to go positive. So bonds are potential bottoming out potential pattern here starting to set up. So if you look at bonds and you look at the weekly time frame for cycle reversal. So basically the way I'll be playing this is that once we start seeing this cycle reversal, the indicator you get once this starts turning up on the weekly long term, that's when it starts looking potentially interesting to maybe go long bonds, but I wouldn't jump into it right now. And then we'd probably do that using TLT, but I'm not getting the signal yet. So you can see we've got cycle 1 positive, but 2 still negative. So you can see it still doesn't know what it wants to do. So basically the way I will first look at it is first on the weekly, we need a cycle reversal right here. We get that, then start getting serious about maybe going long bonds, TLT. Plenty of time. Don't have to jump on anything right now. Okay, well, thank you so much, everybody. Have a great rest of your day and weekend, and I'll see a bunch of you Monday in the room, or a bunch of you hopefully next Saturday at the course. So thanks again. Good luck with your rest of your day and your week next week. Ciao.